This is good stuff.
Oh, I've got this $1 million house and I sell it, there must be taxes on it. Come to find out that's not a true statement, and you could actually sell the property and walk away with a lot of cash in your pocket. I think a lot of the things that kind of go sideways for estates happen before people die. Talking about your death is not a pleasant thing, and talking to your children about your death, it's not a pleasant thing. So I think that's where a big mistake happens, is not setting that stuff up and not being clear about what your wishes are.
I just got chills with what you're sharing because, well, thank you so much for joining me today. My name's Miriam and I work with families who are going through probate or have a trust and need help with real estate. And today I have Karen Hahn, who's with me today. She's a CPA. She's been lovely to work with, and I've also referred many clients over to her here in California. And Karen, tell us a little bit about yourself, please.
Okay, well,
and welcome. Thank you.
Thank you, Miriam. Thank you for giving me the opportunity. So I am a CPA. I'm also, a couple little other titles I hold is I'm a Certified Valuation Analyst, a CVA. What that means is I can value businesses for sale, and there's other reasons that you would value a business, not just for a sale. The other one is I have a Master's of Tax from Golden Gate University. So I've been at this profession for over 40 years, built a practice with employees and such. And this particular area that we're going to talk about, trust, estate, probate, is a kind of a niche area that I really enjoy working in.
Thank you.
Yeah.
So as I previously mentioned, it's pretty rare to find people, at least local people, that have been able to help me in this field as much as you have. And I wanted to discuss all things related to taxes when it comes to inheritances.
Right.
Whether it's probate, trust, and different things in that field. So thank you so much for joining me. I have a list of questions.
Yes. Okay.
Hopefully you can add. I know there's common questions that people have. And you've been in this industry for how long?
I've been doing this for about 40 years. Quite a long time. Yeah.
So I'm sure you've experienced a lot.
I have. I've seen
So there might be things that you want to share with us. So just to start off, can you tell me a little bit about some common tax issues families face when they're inheriting real estate?
Well, on the tax issues, and I think we're probably going to talk about the big one a little bit later, which is called step up in basis.
Yes.
And we can get into some definition around that. But I think in terms of tax issues for families, understand that when somebody passes, a loved one, that whoever's the executor, the family, they're grieving, they're mourning, whether it's either been a long illness or something sudden has happened. It's a shock to the family system.
Right.
So quite often, the issues that I see families have is trying to gather all the documents and the paperwork and try to get everything together that the person who has passed, all those documents, and then try to figure out do they have back taxes like for their individual taxations? That's often a really tough one because where are the records? Where are the tax returns?
Right.
So people really struggle with trying to gather all that stuff together and figure out what returns have been filed and not filed. So that's probably, I would say, the largest tax issue a family might have when somebody passes.
So gathering that data and that paperwork, is there anything specific that a family could do after the fact or even before if they have a loved one who's older? Is there something that they could work on prior to getting into the situation?
I mean, if you have someone, let's say someone who is going to die, it's obvious that's going to happen.
Yeah.
Is to try to have conversations with that person about where are your tax returns, where are your tax documents, what kind of income do you have? For an older person, that's going to be things like Social Security. Quite often, it's going to be pension income, IRAs, 401k type of income. How about brokerage houses? Are you with a certain, a Schwab or a Vanguard, and where are all those documents?
Right.
So for somebody who is going to pass, try to have those conversations. Yeah. But quite often, it's a situation. I've had many situations where somebody here living in California passes, and the executor is back east someplace.
Right.
Right. So now they have to try to come into a house and try to start going through all those documents in those file cabinets and trying to figure out what the person has.
Yeah.
So that's I would say in terms of taxes, it's quite often that's the most difficult process
Yeah,
a person will go through.
that's great. So asking questions if you can in advance.
Yes.
Yeah.
Right.
I had a house actually here in close to Milpitas, who the person lived out of state. She came to clean up the house when her sister passed away. And it took her about 3 weeks to go over all the paperwork that the sister had in boxes.
Right. It
Yeah.
can be, and quite often much longer than that.
Exactly.
And depending on the person's state of mind,
Yeah.
as they become ill and pass, not being able to find that paperwork.
Yeah.
And then you're into another whole thing where you have to, try to contact the Internal Revenue Service, and file Form 56 is the big one. An executor would file
Yes.
to try to figure out where is this person? Do they owe taxes? Have they filed tax returns? What do we need to do next?
Right.
So I would say that's probably the most complicated
Yeah.
tax issue families.
Okay.
Yeah.
Thank you. So we talked a little bit about step-up basis, Prop 19. Is that the same?
It's not.
It's not. Okay.
It's not.
Then I'm
So-
glad that I mentioned that
Yes,
because
it's not the same. It's not the same
Perfect.
thing. Yeah.
Okay.
And people do often confuse it.
So if we're going to get into the conversation, can you tell me a little bit about the difference between both of them?
Okay.
Yeah.
Step up in basis it's a great tax benefit in the Internal Revenue Code. So
Okay.
it's a federal provision.
Okay.
State of California follows along. And just to throw out a code section, it's Code Section 1014.
Okay.
And it's fairly simple, really. When a person passes, whatever assets they have gets what's called a step up in basis.
Okay.
So the two big things are real estate and stocks and bonds in brokerage accounts. Those are the two big things that are going to get what's called a step up in basis.
Okay.
So let me just give you a quick example on like real estate. Let's say mom and dad bought a house 40 years ago, and they bought it for $30,000 here in California, right? And now they've put improvements on it over the years, maybe $500,000.
Yeah.
And then they pass. So what it cost them was somewhere in the range of $530,000, if I can do the math there real quick. But let's say the house is worth $2 million here in the San Jose area. So whoever the beneficiary is, the heirs of the estate, their what's called cost basis is not what it was for mom and dad. It's whatever the fair market value was at the date that they passed.
Okay.
So you can imagine if you're getting ready to sell that piece of real estate, right? You're not going to have this huge gain.
Right.
So your new basis is $2 million. Let's say you sell it for $2 million. Guess what? You actually are going to have a loss on the property because of the sales commissions, right? Same thing with a brokerage. Let's say mom and dad had a big brokerage account that had lots of mutual funds, stocks, bonds, and it's assets they've accumulated over the years, and their cost basis is lower. But then when they pass, whatever those financial instruments are worth on the date of death
Yes.
becomes the heir beneficiary's new cost basis.
Got it.
So it's an incredible tax benefit,
Right.
as you can imagine.
Absolutely.
So quite often beneficiaries can sell those assets and walk away with no tax effect.
Yes. I've seen that happen before.
Yes, it's a huge benefit. Yeah.
So what is now then Prop 19?
Prop 19 is it was passed in November of 2020. It went into effect, I believe it was February of 2021, if I remember correctly. So Prop 19 has to do with the real estate taxes on real estate.
Okay.
All right. So it's a
Yeah.
totally different. It's a state of California. Well, more correctly, it's a county tax
Okay.
on real estate.
Understood.
So it really doesn't have anything to do with federal or state income
Got it.
taxes. Yeah.
So it depends on the county for that one.
No, so it's it's whatever where it's going to become important is whatever the percent that a piece of real estate is taxed for property taxes.
Okay.
So
Understood.
and it's roughly 1.25%
Yeah.
of the value.
I've had clients ask me, well, my taxes, how much, when? That's when I send them to you. I'm like, nope, I need help.
Yeah. Yeah.
And
Yes.
and things do change, right? Laws change and different
Of
things.
course they do.
And
yeah.
so I also try not to get involved in that area because it's not my expertise.
That would probably be wise.
Yes.
Just like someone like myself would not be set up to try to sell a piece of real estate for somebody. I mean, stay in your lane.
Absolutely.
Stay in your lane.
Thank you.
Yeah.
And also, I think as we're talking about that, I had someone who was filing taxes or attempting to on his deceased brother, and he called me for advice, and I said, that's not my lane, and maybe you should talk to a professional as
Right.
well.
Yes.
Because he was trying to do it on his own to save money.
You know, when you say that,
Yeah.
I see that quite often. People will come to me and they want to save money. So they don't want to hire
Yeah.
professionals. They don't want to hire the attorneys and the CPAs and the real estate agents and the appraisers because they want to save money. And quite often they kind of shoot themselves in the foot.
Yeah.
Because there are things that need to be done in a correct order.
Right.
Paperwork that needs to be filed.
Yeah,
Right? And so these
absolutely.
professionals around you know about those provisions and can
Yes.
guide you through that. So I think unless something is just incredibly simple, it's really a big mistake for someone to try to do all this stuff on their own just to save a few bucks.
I agree
Yeah.
with you. It
Yeah.
might be more costly in the end
Yes.
if you do it that way.
Yes.
That's what I told him. So
Yeah.
hopefully he reached out.
Hopefully.
So can you please explain Prop 19 and how it affects children who inherit a property?
Okay, so I think as most people know, Prop 13, and I can't tell you the date that came into being. It's been around for quite a long time, the 70s maybe. I'm not remembering exactly. So what it said is the state of California and the counties cannot just raise property taxes with no limits on it because you're pricing people. Their ability to pay their property taxes
Yeah.
on the piece of real estate becomes very difficult. So that's what Prop 13 was about. Prop 19 has to do with and there's a couple of provisions. We can talk about one provision where a person 55 years or older, right, can sell a piece of real estate and move into buy another piece of real estate throughout California,
Right.
and keep the tax base that they had on the original property. Hopefully that made sense what I just said.
Yes.
And they can do that 3 times
Okay.
in their life.
Okay.
So for example, let's say, kind of getting back to that original example I used, let's say they have a piece of real estate here in San Jose that they bought for $500,000. And so they're being taxed 1.25% of that for their
Right.
property taxes, right? And so now they're ready to retire, whatever, they want to go south to Southern California. And so they're gonna, their house is now worth $2 million, right? So they want to sell that property, they go down south and they're gonna buy a piece of property for $1 million,
Yes.
let's say. So part of the Prop 19 allows them to transfer their tax base, their $500,000 tax base
Yes.
that they had. And so they go down to Southern California, buy a house, and so their tax base will still be $500,000.
Got
Does that
it.
make sense?
It
Did I
does
say
make
that in a way
sense,
that yeah.
And they could do up to 3 times in their life.
Yes.
So they could sell the second home
Yes.
and do it an additional time. And does the home have to be in California?
Yes.
Okay.
Yes, state of California.
Understood.
Sure. Because California, well, the counties actually are
Yeah.
the ones who are collecting the property taxes.
Got it.
Right?
Okay.
Versus, let's say, New York would not,
Yeah.
you wouldn't transfer your tax base to New York.
Understood.
Yeah, it's,
Okay.
it's a California.
Perfect.
California law.
Okay. So that's one of the areas for Prop 19. And what is the other one?
Okay,
Yeah.
so the other one has to do with, and there was a change in the Prop 19. There used to be if mom and dad died, so they had that $500,000 house, and now they wanted to, it was inherited by a relative or whatever, that the relative could now pick up the $500,000 tax base also,
Okay.
right?
Yes.
Prop 19 changed that.
Oh.
All right.
Okay.
So the case where that can now happen is mom and dad can now, a child can inherit that house. All right. So there's 4 rules around that. Let's see if I can recite all 4 rules at one time here. So the first rule is the piece of real estate had to be mom and dad's personal residence.
Okay.
Right. It couldn't be a rental home, vacation home, investment home.
Right.
it
So
had to be-
primary, they had to live there.
had to be primary.
Okay.
Okay. And now mom and dad die, and now the child gets the house. So the child now has 1 year to move into the house and make it their personal residence.
Okay.
All right?
Yes.
If they do that, then they get mom and dad's tax base.
Understood.
All right?
And it could be a relative as it used to be, or only a child?
Only a child.
Okay.
Only a child. One exception to that would be grandchildren. So let's say mom and dad died, and then their children had died, and now they have a grandchild.
Understood.
So the grandchild could move in,
Okay.
but that grandchild's, both of their parents would have had to have passed.
Okay.
Make sense?
Yes.
Okay. And then the other rules around that, there's paperwork.
Yeah.
So there's I think it's a Form P-19, if I'm remembering that correctly, that has to be filed that says, okay, I'm going to do this thing. You know, I'm the child. I'm going to move into this house, make it my personal residence,
Okay.
and pick up the tax base. And then there's the other where you have to file for the homeowner exemption, that $7,000. I don't know how many people are aware of the $7,000 homeowners exemption on your property taxes.
Okay.
And there's a fourth thing which just slipped my mind. There is, and this is going to be a little complicated to try to explain. So this is not an unlimited exemption. So what the child can pick up is, let's see if I can explain this so it makes sense.
Okay.
So as you know, each year your property taxes on a piece of real estate will go up.
Yes.
But it's capped at how much?
Yes.
All right. So let's go back to my $500,000. Let's say over the years that the property tax base has increased to $500,000 for mom and dad.
Yes.
Okay, and now they pass. And let's say the house is worth $3 million, right? The child's going to move in, so they don't have an unlimited cap on that. So it's mom and dad's capped base, $500,000.
Yes.
Plus, and I think you wrote it, it's $1,044,586. I don't know where they get these numbers from.
Yeah.
So your cap would be the $500,000 plus $1,044,586.
Got it.
I think the takeaway on that, because that was a lot of language there, is it's not unlimited.
Got it.
It's not unlimited. There is a cap on how much you can preserve that.
My
property tax
takeaway
base.
is hire a professional who's an expert.
Well, you can see even I had to take a moment and look at my notes.
Because I'm listening and I'm with you, but I'm like, oh, this is complicated. Woo!
Yeah.
So we want to make sure.
That last little piece is a little.
Yeah.
Yeah, the takeaway, there's a cap.
Absolutely. Yeah. Okay.
is a
Makes sense.
Yeah.
And I didn't know it 3 times. You could do it 3 times.
On the 55?
Yeah.
Yeah.
Which
3
is
times.
really good to know that information. And there's so many variables and so different scenarios. So it is good to talk to someone and talk it through.
There is.
Yeah.
I think, especially when it comes to the Prop 19 rules, an estate attorney, I think, is invaluable around that, because there are little nooks and crannies of this law that need to be understood. So I think before you try to execute that plan, let's say, it's good to talk to like an estate attorney.
Yeah.
The other place a person can go is the county. I have found the County of Santa Clara to be able to call County of Santa Clara.
Yes.
They're very, very helpful.
Yeah, I've called them.
Which is not always true of government agencies. But I have found that the County of Santa Clara will help to explain this to you, and you can give your particular fact pattern.
Yeah.
And they're very helpful with helping you understand how this would apply to you and what forms you need to file and all that stuff. So I think the County of Santa Clara, I'm not sure how much the other counties in California are like that.
Yeah.
But my personal experience with the County of Santa Clara are really good. Yeah. Very
Mine
helpful.
too.
Very helpful.
As we're discussing this, a question that has come up multiple times and I forgot to write it down.
Yeah.
Sometimes when we sell a property through probate, the families the property's reassessed
Yes.
and now they owe taxes. And I've had families that come to me and say, it's been a year, there was a reassessment, now I need to pay back and I don't have money.
Supplemental assessments will kill you.
Can you tell us a little bit about that?
It just takes a while for the county to catch up.
Okay.
So let's say, go back to mom and dad dying, $500,000 property.
Yeah.
And, they died without trust or will, so now they're in the probate situation.
Yeah.
And so the heirs, the beneficiaries, are going along and paying the property tax. They're maybe getting the bills in the mail, like you do. And then all of a sudden, like you just said, 6 months, 8 months, a year later, out comes what's called a supplemental assessment.
Yeah.
And it can be
Yeah.
really big. And that's just the way it is.
Yes.
I think a good way of handling that, again, you're talking about tax issues, right?
Right.
This is not an income tax issue. It's a property tax
Exactly.
issue. That's, again, why professionals are invaluable, because
Yeah.
they can tell you that. The other thing is County of Santa Clara
Yes.
will tell you that.
Which I learned when I called the county, and that's
Yes.
where I learned they were helpful.
Yes.
Because this happened once, and I was not. This is the beginning when I started in real estate. Now I tell families,
yes.
be cautious.
Right.
Don't just go spend all the money, because there might be something called the county.
Well, I would say, if I could just kind of sidebar that, I
Yeah.
think anytime, if you're the executor of a trust or a probate, whatever
Yes.
that might be, administrator, whatever, and so you're selling off assets and freeing up cash and stuff like that, it's always a good idea to hold cash back
Yeah.
for, anywhere from 6 months to a year.
Yeah.
If not longer, depending on how complicated. I mean,
Exactly.
I currently have some engagements running that have been running for like 2 and 3 years, because it's that complicated, and or whoever the original person was didn't take the time to set things up. I mean, I think you work with the probate,
Yeah.
and that's all there because the person who owned those assets did not
Yeah.
set up the trust documents, did not,
Right.
provide for how is this stuff going to get passed, and
Yeah.
now it becomes quite the mess. So
It
it's always
does.
wise, even in the simplest of engagements, I think, is to hold cash back,
Absolutely.
because you just never know
You never know.
what's going to pop
Yeah.
up. Yeah.
Actually, one of the attorneys was sharing with one of the trustees that I sold this house that I was helping to hold on to some cash for 2 to 3 years, as you mentioned.
Depending on how
Yeah,
complicated.
because once you release the funds to whoever you release them to, they might not give you money back.
Oh no, no.
Once the money's gone, it's gone.
Yeah, no. And
Yeah.
then as the executor,
Yeah.
you're kind of in a really bad
Exactly.
situation.
Yeah.
So yeah, you have to hold the cash back.
Yeah. Thank you. Okay, so let's see. If a child inherits a parent's home,
Yeah.
we talked about the property tax basis, and we did talk a little bit about them being a relative,
Okay.
and it is applicable.
Don't have to be a relative.
Yeah.
But
Just, is it anyone that can inherit that, the basis, the tax basis, or no?
yeah, it's whoever inherits the property.
Okay, so it could be multiple people, because I've seen
Sure.
cases. Okay, perfect. Thank you so much.
Yeah, step up basis that is the principle.
Okay.
Without getting real complicated around it, why step up in basis? So we can go back to the what's called the estate exemption, and it increases a little bit every year. I think it's currently $13.6 million.
Okay.
Okay, and let's see if I can briefly describe this. If someone dies and their estate is in excess of $13.6 million, okay, let's say it's $15 million.
Okay.
They're going to pay 40% tax on the excess over the 13.6. Does that make sense?
Yes.
Okay. So basically, for people who are 13.6, which for you and I are probably a lot of the people that we know,
Yeah.
right? You're kind of what I call free to go. So in other words, a person can pass on 13.6 million without any kind of estate tax.
Yeah.
That's the step up in basis concept. I don't know if that makes sense or not.
Yes.
Kind of why step up in basis? Because what I just said.
Okay.
The
Understood.
first 13.6 of assets are not taxed at the state level at 40%.
Got it.
Make sense?
It makes sense.
Okay,
Yeah.
great.
Thank you.
Yeah.
I know it's a lot of information.
It is a lot of information to try to take in.
Thank you. Let's see. Next question that we have here. What's the difference tax-wise between someone inheriting a property through a trust versus probate? Is there a difference?
There's really not. Again, we're going to get back to that step up in basis. As you know, and you're kind of the probate expert, Probate just means that the person who owned the assets did not set up legal paperwork,
Yeah.
right? It did not give instructions
Exactly.
on how their property was going to be passed on or what should be done with it.
Yeah.
That's basically what
Yeah.
it means. So what has to happen? The probate court system has to come in and under probate law
Yeah.
decide, okay, how are these assets going to be liquidated,
Distributed. Yeah.
So it's just the probate is just a function of the person not leaving instructions on what they wanted to have done.
Understood.
So in terms of income tax law, what we call, again, that step up in basis, it really doesn't change.
Okay.
It just takes a lot longer.
Yeah.
Probate can take, 8 months, 12 months or
Yeah.
more.
Yeah.
So it just really slows down the whole process. Kind of becomes a nightmare for the executor and the beneficiaries.
That's a great point. So I
Yeah.
have one who she's been going through probate for about 3 years.
Yeah.
And the reason why, because there's some issues with the other beneficiaries and the property is going towards everyone, but there's a couple that live in the home.
Yeah.
So it's been quite an interesting process.
Right.
But should someone who's going through probate, for example, and it's delayed, should they be filing for taxes as they're waiting for probate?
No, so, and filing for taxes. So we can talk about individual income taxes.
Yes.
So like that's the 1040.
Yes.
That everybody files. That needs to be done in the timely fashion that is required.
Okay.
Okay. And then there's also what I'll call the trust or estate taxes, a Form 1041. And again, that needs to be filed in a timely fashion.
Yeah.
Under federal and state tax law. So yes, I mean,
It's an additional.
income taxes and probate, again, they're two separate things.
Yeah.
And so, yeah, probate has its set of rules, income taxes has its set of rules.
Yeah.
So
It's a big responsibility.
it is a huge responsibility. Be careful when you say you're going to be an executor.
Oh, I heard people regretting
Why
it.
did I do this?
Yes.
Yes.
I've had a lot of people say, I regret this the whole job.
Yeah, and I
Yeah.
think if I could just offer a comment on that, for people who have assets, right, we're all going to pass at some point
Yeah.
in the future. If you want to do a huge favor for your children, for your other relatives, even if, let's say, you don't have children and everything's going to go to a charitable organization of some sort, do a big favor and get your paperwork in order.
Yeah.
Get your trust document written, your wills, all those power of attorney things that need to be done, and get them someplace where they can be found. I mean, organize that stuff
Absolutely.
so that whoever comes behind you can figure out
Yeah.
what needs to be done.
Thank you.
Yeah.
I talk about that a lot in my videos because many times when I meet people, they think a will is enough.
It's not.
Yeah. So
It's not.
yeah. So I think
Unless the simplest of, let's say you have no property. Let's say you're a renter, and you really don't have anything. You don't have IRAs or 401ks. You don't have real estate. You don't have brokerage accounts.
yeah.
Maybe you have a checking account, maybe a little savings account. Maybe then a will's okay.
Yeah.
But if you have assets of any sort, a trust is really needed.
Yeah.
Yeah.
Absolutely. One of the attorneys I'm working with, he also does pet trust.
Yes.
So that's another thing
Sure, I
that
think that's kind of funny, but
I mean, yeah.
I can see it, right?
Me too.
Yeah, I've had people that I've worked with who've had they've made provisions for their pets
Yeah.
in their trust documents.
Yeah. I met someone this past weekend and I reminded him, single gentleman
Yeah.
with a dog, and I said, make sure you take care of your dog
Right.
too.
Right. Yeah.
So
Definitely.
yeah.
Sure.
Wonderful. Thank you.
Yeah.
Okay, so how is the date of death value used for tax purposes when someone inherits real estate?
What was the question again?
How was the date of death value used, or what is the purpose of
What is
using
it used?
Yes,
Okay,
yeah.
that's the step up in basis.
Yeah.
It's so if someone dies, what is today, May 12th? So again, the brokerage accounts are pretty easy because you can establish the fair market value of those investments in that brokerage account. I mean, it's published information. It's on a stock exchange or whatever. That's pretty easy. And the brokerage houses, all the big ones, can actually prepare the report of, okay, here was, you've got 20 items in your investment portfolio, and they were worth X amount of dollars on May 12th. Really easy. Piece of real estate obviously is a little harder.
Yeah.
Okay. So, and there's several ways. The best way to come up with the value for a piece of real estate is a professional appraisal.
Yeah.
Right. That's the document, if you will, the professional that helps you. That's going to stand up in the case of an IRS audit.
Yes.
All right. About how much it's worth. I don't know that you always have to have a professional appraiser. Somebody may jump out of the camera at that one. I've also seen appraisals done. So let's say someone dies, and within 3 to 6 months the property is sold.
Yeah.
Let's go back to the $2 million example. The fact that it sold within 3 to 6 months for $2 million, it really does establish what the value was on the date of death.
Okay.
Right? I mean, here in the Bay Area, property does move rather quickly, so it could have gone up in value over that 3 to 6 months.
Yeah.
Other places in the country, maybe not so much. But I've seen it quite often. The property sells very quickly, and the sales price is used as the date of death value.
Got it.
All right. I've also had situations where people come to me and the house hasn't been sold. The piece of real estate has not been sold for 5 years, 10 years, right? And now you have to look back to when that person died. What was that property worth 10 years ago?
Right.
That's a little harder.
Yeah.
Again, professional appraiser is always your best choice. They can do that. They can go back 10 years, market comps and things like that. I've also seen real estate agents work up a market proposal. I'm not sure what it's exactly called.
A market analysis.
Thank you. Market analysis. Not as strong as a professional appraiser would be.
Yeah.
But I think a market analysis works just fine, because what they'll do is they'll go back in time and look at what other pieces of property sold.
Right.
I mean, like an appraiser would do, really. Right.
I'm so glad you're mentioning this.
Yeah.
Because that's one of the questions that I added this morning.
Okay.
I do have clients that reach out to me often for that type of market analysis. And I oftentimes wonder, is this sufficient?
I believe it's sufficient.
Yeah.
Okay. Again, what I will say is, if you were audited with the IRS, they would much prefer a
formal
professional appraiser.
Yeah.
But I'm comfortable with a real estate agent's analysis. I think times when you might opt for the professional appraiser is if there's contention in the family.
Yeah.
It's kind of sad to me. I would say 8 out of 10 families fall apart when somebody dies, and there's money involved.
Yeah.
They start the infighting and the siblings just going at each other. So if an executor knows that they have a beneficiary that is just going to be upset about every little thing and contentious, and then it's like you opt for the professional appraiser.
Yeah.
You go all the way, and it's like, okay, we'll pay the extra money. It's just coming out of your share, but we'll do that.
Yeah. I recommend that as well.
Yeah.
Especially when you have situations, like you said, when family, there's a little bit of maybe questions or issues, or they believe the house is worth a lot more than what.
All the time. Where, oh no, the house is worth, and you should hold out for it. Yeah. So I think in situations like that, where you just know that people are going to be picking at you, I think it's well worth the extra cost for the professional appraiser. Sometimes,
absolutely.
I mean, if it's really bad, you get 2 and 3.
Yeah.
Right?
Yeah, absolutely.
Yeah. Just
because for the county, I'm one of the agents for the county. I'm not sure if I shared that, but for the county, I do provide evaluations But that's in cases in which a county has taken over because there's probably no beneficiaries or heirs or,
Right.
something like that.
Right.
But I'm sure that they will also get professional appraisals done
Yes.
in cases where there is complications.
Yes.
Yeah.
Yeah, I think if the estate is complicated, or again, you have people that are not getting along,
Yeah.
you're going to go with the professional appraiser.
Yeah.
Yeah.
Thank you.
Yeah.
That reminds me of a situation I have right now, and it's become a court approved sale. So now the court is involved, court confirmation. And the beneficiary called me and said, you can't sell the house for the 500, property in Oakland, a fixer, because all of the homes in California are worth $1 million.
All of them.
All of them.
homes.
So that's why I object. So she didn't believe in my
Okay, all of the homes.
appraisal.
Okay. All right. Yes.
Or my market analysis. So now the courts are involved and now
Sure.
they're making decisions, which is fine.
Yeah.
It just has taken us about a year.
Yes. So in a situation like that, that kind of a statement, I mean, what else are you going to do with it?
Yeah.
Okay, we'll go professional appraiser and
Yeah.
we'll let the court handle it, and it's going to cost you extra money.
Yeah.
Yeah.
So now, yeah, they're losing a lot of more money than what
Yeah.
on attorney fees and
Yes.
other fees. So yes,
Yeah.
absolutely.
And I'm just real quickly going to go back to that's where I'll call them mom and dad. I mean, it's so important to establish good paperwork, have
Yeah.
conversations with your children or whoever's going to inherit. I mean, you can really stop a lot of this.
Yeah.
If you just have that, if you prepare,
Yeah,
right?
exactly.
Yeah.
Thank you for sharing that. And
Yeah.
also, I think sometimes parents, like you said, mom and dad try to do the best and maybe assign multiple trustees. I have one that has 4 trustees.
Oh.
And that's been very
Yeah,
chaotic, and
of
everyone
course.
feels differently. So, I don't know. In my experience, it's better to have 1 or max 2, but I'm not sure.
I would say 1.
Yeah.
Because you're exactly right. I mean, if you have more than one, now you have varying opinions, even people who get along well.
Yeah.
Right? I mean, people see things differently and would approach things differently.
Yeah.
So I think 1 is your best case. And I think for mom and dad I have 4 children, and if I only appoint 1, everyone else is going to think that they're my favorite child or
Yeah.
whatever that is. Yeah, it's just
Yeah.
fraught with little landmines.
Yes. I think it's complicated.
Yeah, it is complicated.
So we talked a little bit about capital gains and things like that. I'm not sure this question will be repetitive.
Right.
But if the heirs decided to sell the property, how are capital gains calculated?
Okay, so it's just basically a math formula. So let's just go back to, I mean, here's how a capital gain is calculated. Let's see if I can make this somewhat simple. So you have a sales price. Let's see if I can make the math simple too. Say the sales price is $1 million.
Okay.
Okay. And let's say the sales commissions are $100,000, right? So your net sales price is $900,000.
Yes.
Okay. And step up in basis, code section 1014. The property was worth $1 million when mom died. Let's say
Yes.
mom was last to die. You actually have a loss of $100,000. Make sense?
Yes.
The math on that?
Yeah.
Okay. Let's go to the same example. Let's say instead of selling it for $1 million, let's say you sold it for $1.1 million,
Yes.
$100,000 sales commission.
Yes.
House was worth $1 million and mom died. You now have a gain of $100,000. Did that make sense?
Yes.
Okay.
Pretty simple.
That's well.
Yeah, for me right now.
Yeah.
Those numbers made it simple.
Yeah. Okay.
Yeah.
Good. I'm glad to hear that. It's just in other words, the step up basis establishes what's called the cost basis.
Okay.
That's the terminology for it.
Got it.
And then you compare that to what the sales price is minus the cost of the sale.
Yes.
The other things that can come into play that I think is important to mention is if I'll call it fixed expenses are incurred between date of death and when you sell it. So let's say you redo the kitchen or the bathrooms or whatever that might be, and so you incur cost of $50,000 to do that.
Yes.
That adds into the cost basis.
Got
and
it.
we'll change the amount of capital loss
Yeah.
or capital gain.
So in that last scenario where it was 100K
Mm-hmm.
capital gains, it would now be 50.
Exactly.
Okay.
I most often, when a piece of property is sold relatively quickly after someone dies, I most often see a capital loss
Yes.
because of the sales commissions.
Yes. Understood.
Okay, and then another little piece of that, which might be important, is if in the final year when like a trust is finalized and there's a capital loss, that capital loss can get passed out to the beneficiaries to be used on their personal tax return.
Oh.
Does that make sense what I just said?
Yes.
So example, you have a $100,000 loss because of the sales commissions.
Yes.
And you finalize say 2025 was the final year. And let's say there was 2 beneficiaries. You have a $100,000 capital loss given the math I just told you about.
Yes.
So the final trust tax return is prepared. The tax form is a K-1, goes out to the 2 beneficiaries, and they both have a $50,000 capital loss.
On their personal
on
taxes.
their personal. Wow. Yeah.
This is good stuff.
Yeah, and I think in terms of why would you consult, we can go back to why would you consult a professional. Most people would not know that.
No.
And I think also it helps beneficiaries, well, executors, beneficiaries, it helps them to make decisions about whether they should sell the property or not.
Yeah.
Right?
Right.
Because I think a lot of people think, oh, I've got this house, $1 million house, and I sell it, there must be taxes on it.
Yeah.
Must be, right?
Yeah.
It doesn't make sense not to. And so there's some hesitation. I don't want to sell it because I'll incur big taxes. Come to find out that's not a true statement. And you could actually sell the property and walk away with a lot of cash in your pocket.
Absolutely.
And a capital loss.
Yeah.
Yeah, wow.
Yeah. Great information.
Yeah.
My mind is spinning because I'm thinking about all these conversations that I've had, and I'm like, with people, I need to go back and tell them this one area to reach out to you, and it's huge.
It's huge.
Yeah.
And then there's and we're getting off a little bit track, is there's the decision, do I keep the house and rent it?
Yeah.
Right? Turn it into a piece of rental property. Okay, which has its benefits. Or do I sell the property and take the cash? And I will just tell you, I'm generalizing. When I have made the calculations, it's usually better to sell the house, take the cash, and invest it like in some sort of an investment vehicle than to rent the property out.
Yes.
I'm not saying 100% of the time, but most often you're going to have more annual income if you sell the property and invest than if you keep it and rent.
Yeah.
It's just a little sidebar.
Such a great point.
Little sidebar.
Yeah.
But you don't know until you run the calculations.
Yeah.
And
there's certain things like you're describing now, it's like you just don't know because you don't know. So if you talk to someone and now it's like, oh, wow, this is great information. Yeah.
Right, exactly.
Yeah. Wonderful.
Yeah, well, and I think the other thing about consulting with a professional, like a real estate agent would help you to understand what the market is. And should we hold for a bit, or is it time to put it on the market? I mean, that's important information.
Yeah.
I think also like a tax professional is going to help you understand what your options are, number one, and then help you understand which option is going to afford you, the best outcome economically.
Yeah.
Or maybe the economics of it is not what's important to you.
Right.
So there's, economics is not everything.
Yeah.
There are other issues that emotional issues, quality of life issues, that can come into play. And
Absolutely.
I think having an objective professional helps you to understand those.
Yeah.
I do.
Yeah. I agree with that. Thank you.
Uh-huh.
Let's see. We talked a little bit about this, and I'm not sure again if it's going to be repetitive, but what tax records should a trustee, executor, administrator keep during
Everything.
Okay.
So yeah, I was thinking about this. So obviously, any tax documents that have been received, Social Security statements. I'm gonna rattle off some tax forms here. Social Security statements, 1099-R statements, 1099 interest, 1099 dividend, 1099-S. There's just a host of them. And then, of course, the back tax returns of the person who has passed. And then in terms of what the executor wants to keep, you need to be able to document what you have done. So you're going to want bank statements, brokerage statements. You're going to want check registers. You're going to want paid invoices, things that you've paid. You're going to want to be able to present the bills for what you paid and why. For an executor, a lot of times, they're driving around a lot of different places, so auto records, especially if you have other beneficiaries, or it's contentious, you really want to keep a lot of information. You want like phone diaries, emails, things like that. What I did, how I did it, and why I did it. So you're going to want to keep a lot of that documentation.
Yeah, again, my mind is going because I do have clients, for example, the story that I mentioned earlier, the property in Oakland, where the beneficiary wants us to go through the court process. The person who's selling, who's administrator in the probate case, is flying in out of state every time we go to court.
That's all deductible.
Yeah.
That's all deductible.
I need to make sure I talk to her today about this.
Yeah, well, I'll give you a recent example. I had a person come to me, and their sister had died. And so she needed to do the sister's final tax return. So, and I said, and I always ask for the previous year tax return because it gives me a lot of information.
Yeah.
Well, she had destroyed the tax return.
Oh.
She had shredded it.
Oh.
And then I forget exactly what it was. There were some other documents. I can't remember exactly. And she thought it was done, and so she disposed of them. I mean, I was able to go ahead and produce a tax return for her. But you don't want to be destroying those kinds of documents until long after the whole process.
Is there a time frame that you would?
Well, the general rule on tax records is, here we go with another little math thing, is 3 years from the date that you filed the tax return.
Okay.
All right. So I usually suggest that people save their tax documents for somewhere between 5 to 7 years.
Okay.
All right. That's the general rule. In a trust setting or like a probate, or if you're working through, it can be much longer.
Yeah.
Again, it really depends on who are the other parties. Are they contentious? Is there a good possibility at some point in the future they're going to, like, quote, go after you?
Yeah.
I would say in a trust situation, you're going to want to keep probably more paperwork than you would like at an individual level.
Yeah.
So, and have it organized.
Absolutely.
Yeah. And I think probably have it in some sort of an electronic format.
Yeah.
Because people are going to ask for it. Death certificates, trust documents, which are huge. Trust documents can be 50 to 120 pages.
Absolutely.
You don't want to have to make copies of that every time. So to have some sort of, have it electronically stored is a good idea.
Yeah. I've had clients who I've sold their home and they've reached out years later for the closing statement, which is a packet that they get when we sell the house, and I'm surprised that they don't have it. But then I'm not. So thankfully, I don't even know, but my paperwork probably goes way beyond the 5-year, because I do fear that someone will reach out and then there'll be a trail somehow, hopefully in my end, but still. I
think as I know I do. As a professional, if I have done your tax returns or whatever that work is, I have all of it. I wouldn't say I've got it going back 40 years, but as long as there we go. As long as computers, right? Yeah. I can go back 20, 25 years for some of my clients. Yeah. And have their tax returns and everything in my files. But yeah, things like escrow papers, and when you sell a home, or when you buy a home, whatever, the escrow document is huge. Yes. Right? And there's only a couple of pages that usually are important to a tax return. Yeah. But yeah, staying organized with your paperwork is really important, and I would say keeping more than you probably would at the individual level is important.
Something that I started doing with my clients who don't use computers, because some of my clients don't,
Yeah.
is put everything on a little USB,
Yeah.
whatever stick or what, I don't even know.
Yeah.
We don't use those often anymore,
USB. Yeah.
just to make sure that they have that documentation and save it, because just in case in the future they need that information, I want them to have something to refer to.
Sure.
Yeah.
Yeah.
Yeah. Thank you. Let's see. Oh, buyouts. That's an interesting one.
Buyouts. Okay.
Yes.
Yes.
If someone wants to keep the property at one of the heirs, are there any tax implications or consequences? It's the same?
It just goes back to that early example about how do you compute a capital gain or
Yeah.
it's the same thing.
Okay.
So let's say we have two beneficiaries, and they've inherited a piece of property worth $1 million. Let's say it was the family home.
Yeah.
And so one of the siblings wants to keep the property
Yes.
for whatever reason. And so, they go to the other sibling and go, okay, I will give you your $500,000 cash, right? So for the sibling that has been bought out, in my example,
Yes.
no gain or loss, right? House is worth $1 million.
Yeah.
All right. And sibling one gave them $500,000 for their share.
Yeah.
Does that make sense?
Yes.
No. Yeah.
Right.
We can throw in the commissions there to say, let's say there was a $100,000 commission.
Yeah.
So the sibling that was bought out would actually have a $50,000 loss.
Got it.
Right.
So the one that is bought out has that situation. What about the one that's keeping it? The same?
No, it just increases their basis.
Okay.
Let's go back to our $1 million, where they inherited their half was a $500,000. And so they pay their sibling a $500,000. What's their new basis? It's $1 million.
Yeah. Got it.
Yeah.
Okay.
So it's really it's no different than the previous rules we just talked about.
You make it sound so easy.
Out of yours. I would say that particular aspect of real estate and brokerage accounts, those are the two big ones, are really not complicated. It's really that simple.
Yeah.
A basis is established on a date of death, and now how much you sell it for will determine gain or loss.
Got it.
It's that simple, yeah.
Thank you. So are there any big mistakes that you notice, or anything, now that we're getting close to the end, anything that you'd like to share, that things that maybe I didn't ask you about that you want us to consider and people to know, must know?
Big mistakes. I think a lot of the things that kind of go sideways for estates really happen before people die, right? I go back to mom and dad again, and there's a lot of psychological, emotional reasons for that. I mean, talking about your death is not a pleasant thing.
Yeah.
And talking to your children about your death,
Yeah.
it's not a pleasant thing.
No.
And people want to avoid that. It goes back to mom and dad. I mean, you have children, 1, 2, whatever it is, and then how are you going to set up your estate and the directions so it distributes to the children? I'm going to use children. There are other beneficiaries, obviously, right? It doesn't have to just be children. I mean, what are your desires? What are your wishes? How do you want that to be split up?
Yeah.
I think something we didn't talk about is the person, let's say the child who has like a special need,
Yes.
right?
Yes.
And so maybe it's a person that's not going to be able to take care of themselves, right? So
Yes.
mom and dad want to do that. And that's a whole other area we talk about special needs trusts and everything. But where things go haywire is when mom and dad are not really clear about what that's going to be.
Yeah.
Right? And now they die, and now the siblings find out, like, what?
Yeah.
You were always mom's favorite, and then it starts.
Exactly.
So I think that's where a big mistake happens,
Yeah.
is not setting that stuff up and not being clear about what your wishes are.
Yeah. I just got chills with what you're sharing, because some of the just communication, and I know it's very challenging for families to talk about this, but I've seen, again, how families are disrupted, and
Oh, yeah.
one of them believes that mother was going to leave him the house, and now the other 5 are upset that he's living there, and he's a freeloader, or
Oh, yeah.
for example, and it's just all these things that happen, and I've been in the
Right.
middle of it,
Yeah.
where it's just so sad.
It is very sad.
Yeah.
It's very sad. And quite often families blow apart.
Yeah, they do.
And I mean, I've seen numerous times when the siblings will just, they're at war with each other, and
Yeah.
then finally, when things get resolved and take care, they don't talk to each other again.
I know.
It's done. So I don't know. It's not always mom and dad's fault, right? I mean, it's just
Yeah.
it's sometimes it's just your family are not always your best friends, are they?
No,
Yeah.
they're not.
Yeah.
Wonderful. So we talked a lot about a lot of topics. Anything else that you want to share with us before we let you continue with your day?
Off the top of my head, I think I've covered pretty much everything I would talk to somebody.
Yes.
I don't think I have any additional words of wisdom beyond what we've talked about at this
Thank
point.
you.
Yeah.
And if someone wanted to work with you, just call your office. We're going to share the information
Sure.
down below in the video. Is there
Yeah.
anything that they should be prepared for, or any documentation they should have in advance?
What I do, like in the initial interview, is I'll just have them come in. Things that I like to have on the initial interview is I like to have the last tax return. I'll say mom and dad again. Mom and dad filed. It gives me a lot of information to be able to look at an individual tax return, a 1040.
Yeah.
I can know a lot of things about a person by looking at their tax return. Death certificates is always a great thing to have available. And then the trust and or will document. So those are probably the three big things. And then we go from there. In that initial consultation, I'm going to want to understand what the assets of the estate is.
Yeah.
And then, I will go through the whole step up in basis discussion. A lot of people know that idea,
Yeah.
but are always surprised to know that they can most often will come out of a situation like that with no taxes. So it's always kind of a good feeling. It's a great legacy
Yeah.
that a parent can leave, right?
Absolutely.
So that's kind of the interview process, is just to gather documents that we've kind of talked about. And then establish what are the assets that are in the trust, and then also other professionals. I mean, I'm always guiding people to like estate attorneys,
Yeah.
and real estate agents.
Yes.
I kind of like the estate attorney to drive the bus.
Yeah.
Very frankly. And then the other assets are contributing into to making it a good experience.
Exactly. It's
Yeah.
like the way that I view it, like a puzzle or different components.
Definitely.
And we're working towards the same outcome, but we're supporting each other in
Yes.
different areas.
Yeah.
Yeah.
But that's what an initial interview would look
Yeah.
like. Yeah.
Sounds good.
Yeah.
Thank you so much for joining
You're
me.
welcome. Thank you.
Thank you.
Thank you.